On Point with Craig's Investment Partners.
All right, good morning, everybody. Remember, before we begin, the information provided here is general in nature. It's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, you should always contact an investment advisor. And you can find out more about our services in that regard at our website, which is craigsip.com. All right, today I wanted to talk about unemployment. We had two sets of labour force figures out last week. We got our own labour force report for the March quarter here in New Zealand, and we also saw the monthly jobs report in the US. I want to talk about those, what we saw, and I also want to just talk about unemployment and the labour force in the context of the economic slowdown or even recession that people are talking about and expecting. Because I do get a lot of people question me, how can there be a recession on the horizon when unemployment is still really low? And with the labour force so strong, there can't be a slowdown coming because everyone's got a job. So I just wanted to talk a little bit about that because, it is a bit more complicated than that. And you can actually have a situation where the economy slows or even falls into recession when you've got a very strong labour market. So we'll talk about that. First of all, let's talk about the details of those two reports themselves. Look, in both cases, long story short, the labour market in both countries still very tight, wages still rising solidly, even at a slower pace. And things are looking quite solid in a labour market sense in both New Zealand and in the United States. Here in New Zealand, our official unemployment rate sitting at 3.4%. Now, that is the same as it was a quarter ago, and it's a little better in the sense that it's a little bit lower than people were expecting. It's not far above where it was early last year when it fell to 3.2%, which is extremely low. In fact, that's the lowest we've seen since the early 1980s. So we're basically at full employment. When your unemployment rate's down to sort of 3.5%, it's basically full employment. There are all sorts of social reasons and other reasons why we'll never get to 0% unemployment. So 3.5, even 4 is extremely low. You may as well say that's pretty much full employment. Similar story in the US. Their unemployment rate also at 3.4%, and that is equal with, I think, what we saw in January in the US, and that is the lowest that we've seen since 1969, so more than 50 years ago. So quite amazing that you've got these extremely tight labour markets in both countries. When we look at the detail of those measures, you see strength across the board. The participation rate is something that I keep an eye on in the New Zealand context, and the participation rate is basically that measures the proportion of the potential workforce who are employed or looking for work, and that's at a record high. They started collecting that data in 1985, and it's sitting at about 72% at the moment, which is the highest we've ever seen. So again, that just corroborates that evidence that that the unemployment rate is very strong and that the labour market is very tight. I think the reason why you've got a very high participation rate is probably two things. Probably cost of living pressures. People sort of have to go back out to work to earn money. And also there's lots of good opportunities out there. Many employers are quite keen to attract good staff. Something else I watch is what they call the underutilization rate in New Zealand, and there's something similar in the US called the underemployment rate. And those two things are both broader measures of unemployment, and they pick up things like, maybe you've got people who are working part-time, but they really want to be working full-time, or they want more hours. People like that get counted. They're not part of those unemployment statistics in terms of the unemployment rate, but they also aren't getting as much work as they would like. So there's other examples, but that's one that's really easy to sort of zone in on and explain. And these other measures pick up those sorts of things, which mean that you get a better picture for how the labour market is actually looking. And in the US, underemployment is sitting at 6.6%, so higher than their unemployment rate of 3.4, but still the second lowest that we've seen since they started collecting that data in 1994. So the labour market's still strong. In New Zealand, I think the underutilisation rate is 9% off the top of my head. And I think we have data going back sort of 10 or 15 years, and it's at the lowest that we've seen over that period. So all of these things are telling us the same thing, that the labour market is very tight. Wage growth is still very strong. In New Zealand, average hourly earnings increased 8.2% from a year earlier. So that's very strong, and it's probably there or thereabouts with the inflation rate. So keeping pace with inflation on average. Not everyone will have got a pay rise as strong as that. You have seen some segments get particularly big pay rises, and that probably skews the numbers, but that's an average. It's down from where it was running at last year. It got as high as 8.6% at one point last year, but it's still extremely high. So all of these things are very good on the one hand. Low unemployment, everyone having a job, fantastic. Strong wage growth, also fantastic. Lots of jobs in New Zealand just simply don't pay enough. We want to see those hard workers get the wage growth that they deserve. Those things point to a resilient economy, steady economic activity. When you feel confident about your job security, when you believe that you're going to keep your job, it's not at risk, then you'll continue spending, you'll continue behaving and living as normal. That just keeps the economy ticking over. And when those wage gains are coming through nicely, that is helping offset increases in mortgage rates and the cost of living. So those are all good things on the one hand. But at the same time, that backdrop is keeping central banks nervous about inflation and the threat of a wage price sort of spiral. That means they're keeping interest rates high or increasing interest rates. And I suspect we've still got one left in the tank, at least here in New Zealand. So it very much is a double-edged sword. Excuse me. So, you look at that sort of backdrop and you think very strong labour market, everyone's got jobs. How could a downturn be possible? Why have you got the Reserve Bank of New Zealand still telling us that there's a recession coming later this year? Why are some of the staff at the Federal Reserve in the US also telling us that they expect a US recession later this year? And you've got all the major banks in New Zealand, which all have very good economics teams, also predicting a recession. So it doesn't seem to add up, does it? Even if you're saying there'll be a recession, but it will be a relatively mild one. Nothing like sort of what we saw in the global financial crisis or even in the pandemic of 2020. Even if it's a mild one, it still doesn't make a whole lot of sense, does it? So I guess the thing we need to understand is that if you're looking for clues to give you a signpost of when the next recession might arrive or recovery, then the unemployment rate's just not a very good one. It tends to be very much a lagging indicator, so it doesn't tell us a lot about where the economy is going. I know it sounds a bit counterintuitive, but that is the case. Unemployment or the labour market is often very strong heading into a recession, and you often only see the unemployment rate rise once the recession is already here, once it's become entrenched, and then it often keeps rising even after the recession's over. So if we go back to the GFC, December 2007, so the end of 2007, that's just as New Zealand was falling into recession. And at that point, the unemployment rate was extremely low at 3.4%. Pretty much the lowest. It was a multi-decade low at that point, and it's at exactly the same level as it's at now. So even though we were just falling into recession, got very low unemployment. And once we were in recession, then it started rising, and then it didn't peak until the end of 2009, 2 years later. And that was actually 6 months after the recession ended. And I'm trying to recall where it peaked. I think it was about the 6.5% level. So it rose from 3.4 up to 6.5, but it didn't happen. It happened after the event. It was lagging what was happening with the economic cycle. Similar story in the US. If we look at the 11 recessions since 1950, so you get one every 6 or 7 years, I suppose, on average. Are we due for one? Depends. We had one in 2020, but that was sort of an oddball one, and then there was a lot of stimulus afterwards. So some people would say yes, we are. But in those 11 recessions, the unemployment rate has averaged 4.7% as each of those recessions started. And that's only marginally above the average low point, the average cycle low unemployment rate of 4.4%. So I guess my point is that going into those recessions, the unemployment rate has always looked pretty good. It's always looked quite strong. 4.7 is not a whole lot above 4.4. And if we again look at the GFC, in the US, the unemployment rate at that point, heading into the GFC, I think it got as low as 4.4. And just before the recession, it was sitting at 4.7. So that's just coincidence that matches the averages. But my point is that heading into those periods, unemployment can look very low. The labour market can look very, very strong. And there's a few reasons for that. If you think of it from the perspective of a business. In the early days of a slowdown, when you're starting to see things taper off, you're starting to see some of those signs of business slowing, you're quite reluctant to lay off staff. You don't do that straight away. That's probably the last thing you do. You're not sure if the slowdown will be short-lived. You're not sure of how much worse it'll get, how long it'll last. So you're not going to get rid of all your staff right away. You want to keep that productive capacity just in case the weakness proves short-lived and you need those people to sell more products. And that's especially true following a period where it's been difficult to get staff like it has at the moment. Every business out there is finding it really difficult to get staff. And that's been the case for the last 2 or 3 years. So even if you're starting to see weakness across your business, you're not going to let any of these great workers go, because you know how hard it was to get hold of them in the first place. And the last thing you want to do is to have to go back out to the market and rehire and go through all that and have that downtime, that lost productivity. And then you've probably got to bring someone on at, potentially even a higher wage than the people that you've let go. So businesses are very reluctant to let staff go, and they often don't do that until they have no choice. So they're reluctant to let those staff go until it's absolutely obvious that we're in recession and they have to do that to maintain their margins or try and sort of reduce costs and so forth. And you have the similar thing coming out of a downturn. When the recovery first takes hold after the recession, businesses, the first thing they do is try and get more out of their existing people. They're a bit cautious about taking on any more permanent staff because, is the recession really over? Or are we really in recovery mode? We'll just wait and see. We want to see a bit more evidence. So there tends to be a lag on the other side as well. And because of that, because of those two things, the labour market and the unemployment rate tend to be pretty average economic indicators when you're looking forward and trying to ascertain, what's ahead of us. So economists and strategists and market watchers will watch all of the economic data out there. And the unemployment data, the labour market data is extremely important, but it's just not particularly good at telling us what is coming in an economic sense. You probably get more out of looking at things like the consumer confidence surveys or the business sentiment surveys or activity indicators like PMIs, purchasing managers, indices. All of those other things, the shape of the yield curve, which is sort of short-term interest rates versus long-term interest rates, all of those things tend to be better leading indicators than The labour market. So I guess my point that I'm trying to make is we've got very strong labour markets, and that's fantastic. It's a reason to be encouraged, but it's not a reason for us to be complacent. There are other indicators that are telling us that there could be cloudy skies ahead. And while I don't believe a recession is inevitable, I know everyone's predicting one, and sort of we're waiting around, and people seem to think it's just a matter of when rather than if. Look, who knows? There is a chance we dodge a bullet, or at least avoid a severe downturn. The recession we do get could well feel more like a slowdown. So I don't think that we're in for something like we saw in the GFC. But who knows? So I think we've just got to be conscious that the last few years have been so unique with the pandemic and shutting down the global economy. Then all the massive stimulus that came back in, and the switch from spending on goods to spending on services, and all that disruption, it's made it super difficult to try and forecast accurately. So central banks, economists, a lot of extremely smart people and teams out there are trying to predict what will happen next, and they're looking at their playbook of what the yield curve is telling them, what the leading indicators are telling them, what these things have worked very well in the past are telling them. And that's extremely important. But I do feel that we need to just acknowledge that forecasting has become much more difficult, and some of those usual rules of thumb might not work quite as well as they did in the past. So just important to keep that in mind. And you can get things that come out of left field that will surprise you. I think here in New Zealand, something that's been surprising of late is migration. We haven't talked about migration as an economic driver for years because we haven't seen it. That was something that was very prevalent in the John Key era, where we had strong migration, and while that caused us some issues in terms of not enough houses, not enough infrastructure, it was fantastic for economic activity and growth, and it brought more people into the labour force, which kept a lid on inflation, which kept a lid on interest rates, and so on and so on. We haven't talked about that for a long time, but in recent months, migration's actually been very strong, and we don't know if that'll continue. The data's notoriously unreliable, and it tends to get revised. So what you think was strong migration might turn out not to be if it's revised down, but it might stay strong. And that's just one example of a positive surprise that people didn't see coming, and parts of the economy could prove to be a bit more resilient than expected if that continues. On the other hand, we've got an election coming up. You've got businesses that will become increasingly cautious just because it creates uncertainty. You don't know what the policy backdrop's going to look like. You don't know if the goalposts will be moved. Businesses do tend to sit on their hands heading into an election. So there's a lot of factors at play. But I guess, my point is really that low unemployment, that healthy labour market, definitely encouraging. Let's celebrate those, because it's fantastic that you've got a strong labour market. People have got jobs. People are getting pay rises. That is offsetting some of the cost of living. It's meaning that you've got a more buoyant consumer, but it doesn't necessarily mean that everything is fine and that there isn't trouble ahead, because in the past we've seen plenty of examples where we've actually fallen into a recession while unemployment was very low and the labour market looked very healthy. So don't get excited. Still plenty of things for us to keep an eye on, and those of us that work in financial markets and spend our lives trying to inform you and guide you and build portfolios for you that will be resilient. We will continue doing our best, monitoring all of these indicators and trying to ensure that your wealth and your capital is protected as best as it can be from any adverse weather conditions in the metaphorical sense that might come at us across financial markets. All right, thanks for listening. We'll leave it there, and we'll talk again soon.
For more insights, visit craigsip.com.